How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about the bank's branch network. How can banks how can they maximize their branch network and really get the most out of that investment and hopefully out of growth opportunities through that branch network? So I saw this great article in Bank Director that I want to bring in for everybody now. And this is called basically how banks can capitalize on their branch networks. A financial institution's branch network is their greatest investment and opportunity for growth. And we need to learn how banks are making the most of their retail banking locations. So this article gets into basically what are banks doing ultimately to maximize that branch network. Banks are going all in on their retail channels, as PNC Financial Services Group recently announced of a new $500 million investment shows. But just how much benefit do banks gain from their branches? Even as digital transactions soar, financial institutions still rely on their branch networks to attract customers. In an era where competition is fierce from banking giants and fintech companies, financial institutions face a pivotal choice: adapt and leverage their unique advantages or risk losing their foothold. Amid this evolving landscape, one powerful asset remains resilient: the local branch. Once seen as a relic of traditional banking, the branch is making a bold comeback. Wow, imagine that. Establishing itself as a cornerstone of customer acquisition and loyalty. Branches aren't just buildings, they're where banking relationships begin, deepen, and thrive. According to a recent Adrenaline report, the branch is home to nearly 3/4 of new to bank sales, and consumers use branches more than any other channel to open accounts and get advice. However, branches must evolve for banks to realize their full potential. Um, and here we have kind of an interesting chart that basically says the design and construction clients outgrow the industry in deposits. So, and then on the kind of the deep red there is retail banking industry deposit CAGR. And then in the kind of lighter red, maybe even somewhat orange, Adrenaline design and construction client deposit CAGR. So you can see there, basically people that are basically redesigning, doing construction, adapting their branches are seeing a much larger return on investment, if you will. So in the branch advantage, Adrenaline evaluated bank and credit union branch transformation success. The report uses key qualitative and quantitative measures and includes a survey of clients that have invested in branch updates over the last decade, as well as industry research and institutional performance following an investment in branch banking channel. If institutional uplift is the driver for branch investment, just how much growth are banks unlocking? So the data reveals that banks and credit unions that invest in their branch networks yielded stronger returns and grew faster than the financial services sector at large. And then furthermore, not only does a bank or a credit union's branch grow after investing in their branch network, but individual updated branches lead to new opportunities in the marketplace. So responding to market potential, Veribank updated its existing branches while expanding into new markets. Following a 2018 acquisition, the Texas Bank launched the new Veribank brand the following year, sparking a wave of renovations to align its branches with the updated brand. The community banking leader has seen a 154% return on investment across the branch network, transformed 70% of its current branch footprint, and realized a 93% reduction in teller transactions, which has freed up its staff to develop higher value customer relationships. We really do believe that a well-transformed branch is a billboard. Another bank leveraging their network for success is Mississippi-based Guarantee Bank. With a focus on growth, the bank modernized its brand in 2018 and rolled out a fresh banking experience into its branches. So, and then we have a little chart here again that says, to what extent did your institution experience customer/member growth following the branch investment? 33% said up to 2%. 3 to 5% said 11%, 6 to 10% said 34%, and more than 15%, 22% realized a more than 15% growth basically growth following their branch investments. So I think those are some pretty strong results there. So the branch represents the largest institutional investment that most banks and credit unions will make, and the needs to enhance the experience are ongoing. Branch changes provide a significant edge for institutional efficiency and customer experience. So for banks and credit unions embracing more transformational change, the branch delivery channel benefits from a renewed purpose and provides organizations with a powerful platform for growth, opportunity, or for future opportunity and growth. So I thought this article was really interesting because, again, I think when you go back over time, the death of the branch, if you will, has basically been a long time coming. I mean, I think ever since I got into the banking business almost 25 years ago, it was, first it was online banking was going to kill the branch. Then just, digital transformation was going to kill it. I mean, everything was going to kill the branch, but yet the branch remains. And why is that? I think there's a couple of very powerful reasons for that. Number one, there is I believe what is the most powerful is the psychological attachment. In other words, you open up accounts at a bank and, you're driving down the street and you want to see your bank. You want to see the bricks and mortar and know that your money is safe there. Now, younger generation might be okay with more of the the digital banking experience and maybe not going to might not have that psychological attachment, so to speak, to the bricks and mortar. But the older generation, certainly Gen Z, baby boomers, and so forth, they absolutely have that attachment. And then the reality is, a number of studies have pointed out the fact that the two top reasons that people still like to go into the branch are to open accounts and to talk to bankers about loans. If you need to get a student loan for your child, if you need to take out a residential mortgage, if you need to get a home equity loan, if you need to get a small business loan, people still like to go into the branch and talk with their banker. That is still a very big driving force there. Now, what banks have to take into consideration is that foot traffic is certainly lessened, right? Foot traffic is really going down. You're definitely not seeing as many people in the branch as used to. But if you perhaps renovate your branch, modernize it, so to speak, give people a different kind of experience there. I mean, gave a couple of examples in the article here: VeriBank, Guarantee Bank. Obviously, people have seen like the Capital One with their cafe bank, if you will. I would be curious to see a little bit more about Capital One's, the results that they've had there with that whole cafe bank and the experience, and have people really liked it? Have they not liked it? Have they really gravitated towards it or not? That would be really interesting to kind of see some of the research there behind that. I should probably investigate that a little bit more, see what happens there at Capital One. If anybody has any comments on that, please make sure to leave that in the comment section. I would be curious to hear people's thoughts on that. But again, I think the reality here is that your branch is still a huge part of one of your major channels for growth, for providing consistency, great customer service. All of that runs through your branch network. Your branch network still adds a tremendous amount to the branding, the marketing, the overall value of your bank is really tied up in a very large way to your branch network. So the idea that the branch is going to go away, I think, again, is that's not happening anytime soon. And the number of branches does continue to decline, but what you're seeing is the much larger banks, your Wells Fargo, your JP Morgans, your Bank of Americas, they are reducing the number of branches that they had. However, certain banks like JP Morgan are actually growing their branch network. PNC Bank growing their branch network organically by adding in new branches into markets in the U.S. that they're not currently in. So again, it's not all negative. I mean, I think what you're seeing there is if it's a small bank and they want to continue to grow, they really have to grow their branch network. They have to grow their branch footprint. If it's a bigger bank, again, like a PNC or a U.S. bank, somebody like that, the digitization, if you will, of a lot of the different channels and products and services of the bank have allowed them to basically be able to service the same number of customers with less branches. So they can reduce some of the branches, increase efficiency, and just run a better bank, a better organization, a more profitable organization. But again, I think the trick here is that if you want to see a better return on your investment, you have to adapt. You're going to have to adapt the branch over time to basically fit, a new customer experience, if you will. So, but again, thought this was a great article. Make sure to go check it out when you have a chance. And with that, I'll basically wrap up and say, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the other content on the channel. And I will see everybody again real soon. Thanks a lot.